Good evening, friends. Today we are going to take a super fast revision of IND AS 115, Revenue from Contract with Customers. This is one of the most important standards for your syllabus, CA or CMA final syllabus, and in every exam you'll get a question on IND AS 115. In order to understand IND AS 115 better, the presentation part, you can purchase this book called Summary Chart from our website vino.in. The link is provided in the description box below. This book covers in chart form summary of every chapter. So you can go for this summary chart book, or there is one more very good book for our student, and that is compact book. This compact book covers your entire syllabus in few pages in simplified format, summarized format, easy to read one day before the exam. So I would request you to have this summary chart or compact book with you so that you can understand better. But for the time being, you can just follow the presentation and you'll be able to understand. Remember, this is a super fast revision, so in 1 hour we will try to give you complete idea about IND AS 115. We are not going to solve numerical questions today. If you want more numerical questions for practice purpose, we have a book called Compiler. In this compiler, chapter wise we have given questions of study material, RTP, MTP and past exams. So you can purchase this FR compiler from our website vino.in, where you will get all questions asked in study material, RTP, MTP exam chapter wise. It is very useful book because nowadays most of the questions in the exam are from institutes publications only, most of the question, but not all questions. So you can find all question and their solution in the compiler book. Okay, so here we will go. If you have any query, any doubt, you can message me right now, or you can message me later on our email ID. This official email ID asfoundation1@gmail.com, and my personal ID is vinod_ca@yahoo.com. Also subscribe to our YouTube channel AS Foundation, because now we are going to start a series of super fast revision on most of the important standards. So I will try to take this revision on most of the important standard, if not all. Okay, so thank you very much. Let us start this amazing journey of FR revision, starting with IND AS 115. So first we'll check the scope of the IND AS 115. This standard is called revenue from contract with customer. It applies to all contract with customer. It applies to all contract with customer, but it does not apply to lease contract. There is another standard, insurance contract, another standard, financial instrument, we have other standard, and certain non-monetary exchange. Non-monetary exchange means exchange of goods for goods. So certain non-monetary exchanges are also not covered by this standard. Before we proceed further, let us have a look at some of the important definitions, like definition of a contract. Contract is an agreement between two or more parties that create enforceable right and obligation. So it is a contract which is enforceable by the law. Then customer. Who is a customer? Because the name of the standard is revenue from contract with the customer. So the party, the other party, the counterparty should be the customer. So customer is a party that has contracted with the entity to obtain goods or service that is the party who wants to buy goods and service which are input of the entity's ordinary activities. It should be ordinary activity, goods and service produced in ordinary activity in exchange for consideration. Then it is called customer. Now we'll come to definition of revenue. Revenue means income arising in the course of entities' ordinary activities. All income are not revenue because only income arising from ordinary activity will be revenue. Income is a wider term. Income means increase in the economic benefit in the form of inflows or enhancement of asset or decrease of liability that result in increase in equity. So for a company, dividend can be an income, rent received can be income but may not be revenue. Then we'll discuss standalone prices. Standalone price means the price at which goods or service will be sold separately to a customer. This concept of standalone price is required when two or more products are bundled and sold together. In that case, the standard would require you to allocate it on the basis of standalone prices. Now next is performance obligation. The standard would require you to identify performance obligation. What is performance obligation? So performance obligation means a promise to transfer to the customer either a distinct or a bundle of goods or services, a series of substantially the same goods or services. So either it can be one good. So I sell you one mobile phone if I am a mobile phone dealer, or you have given me an order to deliver 2000 mobile phones. I may deliver it over a period of time. Per month I may deliver 100, 200. So a series of substantially the same goods or service that have the same pattern of transfer to the customer, and the pattern of transfer is both over time and represents the progress towards complete satisfaction of the performance obligation, like delivering goods in lots over a period of time. This standard is called 5-step model. It gives you that revenue should be recognized by applying the principle of 5-step model. What are these 5-step model? Step number 1 and 2 is to identify the contract with the customer and identify the performance obligation in the contract. Step number 3 is to identify the transaction price. Step number 4 is to allocate the transaction price to each performance obligation if there are more than one performance obligation. And the step number 5 is to recognize the revenue when each performance obligation is satisfied. So as and when performance obligation will get satisfied, the revenue related to that performance obligation will be recognized. So if a car dealer has to sell car also, provide after sale service also, warranty also, so there are 3 performance obligation, and accordingly the revenue is recognized when each performance obligation is satisfied. Now we'll discuss in detail what are these 5 steps. Step 1 is to identify the contract with the customer, because the name of the standard itself is contract with revenue from contract with customer. So what are the features of a contract? Under IND AS 115, the contract can be written but not necessarily. Contract can be oral also, or sometimes the contract can be implied by an entity's customary business practices. So oral, written or implied. As per IND AS 115, it requires that contract should have all the following attributes. First is contract should be approved by both the parties. The seller and the customer both should approve the contract. Second, the rights and payment terms regarding goods and service to be transferred can be identified. So rights and payment terms are identified. Third is the contract should have commercial substance. That means contract should result into change in the cash flow to the parties. That is commercial substance. And it is probable that the consideration will be received. That is considering only the customer's ability and intention to pay. So if these conditions are available in a contract, then this is a contract for the purpose of this standard. Can two or more contracts be combined? Can two or more contracts be combined for the purpose of accounting? The answer is, if following conditions are satisfied, then two or more contracts can be combined as one contract. The first condition is contracts are negotiated as a package. So all contracts which you have to combine are negotiated as a package with a single commercial objective. And second condition is the contract for each contract is interdependent on the other. The price of one contract is somewhere interdependent on the price of other. And the third condition is they represent a single performance obligation. If these three conditions are satisfied, then contracts can be combined for accounting purpose as one contract. Then what is the meaning of contract modification and what is the accounting treatment for that? So first contract is to construct a building. The second contract may be to construct a warehouse near the building. Will it be treated as a modification or will it be treated as a new contract? So how to do the accounting in that case? The first order was to construct a building. Then the contractee says you add a swimming pool also in that building. Whether it will be treated as a separate contract or a modification of an existing contract. So here I am going to give you the guideline in simple terms, very important for exam purpose. If new performance obligation is added, new performance obligation is added at standalone price. This is building, this is warehouse. Warehouse is negotiated on a standalone price basis, on its own, based on current market condition. Then it will be treated as a separate contract. Second is fully unperformed performance obligation is modified. Fully unperformed performance obligation is modified. So if the performance obligation is not yet done and it is modified, then it will be adjusted on a prospective basis. But other than these two, in other cases, any change made in the contract, it will be adjusted on a retrospective basis. That was part 1, identify the contract. We have seen the definition of the contract, when contract can be combined, and when to do how to do accounting of modification in a contract. The second important step is to identify the performance obligation. How many performance obligation the entity has towards the customer? If I am selling my Google Drive pen drive on FR and I have to also give you the study material, I have to also conduct test. So then I have 3 obligations. I have to give you video lecture, I have to give you books, and I have to conduct the test. Similarly, when a car dealer sells a car, he will deliver the car to you, he provides after sale service, he provides warranty. So you can say there are 3 performance obligations. Depending upon the number of performance obligation and when they will be satisfied, the revenue is recognized accordingly. So identify performance obligation. Performance obligation means promise made to the customer under the contract. What are the promises we have made to you? The promises made can be explicit or implied. promised goods and services are identified as performance obligation if such goods and services are distinct. So very important, the performance obligation will depend when goods and services are distinct. Sale of car is one performance obligation, warranties another performance obligation, after sale services another performance obligation. When will you call goods and services are distinct? Goods and services are distinct if both the following conditions are satisfied. Very important. For a theory question also, remember, customer can benefit on its own from such goods or service. That means customer can independently benefit from such goods and service or can benefit by obtaining resources which are available in the market. So a computer is sold and a printer is also sold. So there are two performance obligations because customer can benefit from the computer, and if he wants he can easily buy a printer from the market. So in this case we will call there are two performance obligations, and such goods and services are separately identifiable. So what is the meaning of this last line, separately identifiable? It means goods and services which are promised should not require any integration between them. For example, in construction of a building, there are electrical work, plumbing work, carpentry work, okay, so many other activities which are integrated, interlinked with each other. You cannot get individual services, so they are not separately identifiable. So the items should not require integration between them or should not be dependent on each other arising from customization or other reason, and they should not require customization. Then they are called separately identifiable. Then they will be treated as separate performance obligation. One typical question comes in the exam about the accounting treatment of discount voucher or loyalty point. Nowadays when you go to a shopping mall or even online, when you buy something you also get a discount voucher, coupon, loyalty points which you can redeem at a future date. So what is the treatment for that? I have made a small summary, very useful to you. These are treated as a separate performance obligation. Even when the entity gives discount voucher or loyalty point, it will be treated as a separate performance obligation because you are promising to supply goods or service at a later date at a discount. So what is the accounting treatment? Accounting treatment for discount voucher is first calculate the fair value of the discount voucher. How do you calculate the fair value of discount voucher? Effective discount percentage we will take. What is the effective discount the company is offering into expected future purchase into probability of redemption. This will give you fair value of the discount voucher. In the case of loyalty points and cashback scheme, the fair value is equal to points accrued into value per point into probability of redemption. Nowadays on that TV, Tata New gives you some new coins, Tata New coins. So this is how you will do the valuation of that discount voucher or loyalty points or cashback. Points accrued into value per point into probability of redemption. Points accrued into value per point is equal to cashback. So depending on the scheme, we will do the calculation of fair value of discount voucher, loyalty points, cashback. These values are calculated at inception. These values will be calculated at the beginning, and on every reporting date they are revised because the estimation will keep changing. Its change is called a change in accounting estimate. So if your estimate of probability changes, we will call it change in estimate. It will be given prospective effect, not retrospective effect. Step number 2 is to calculate standalone price at the inception for all performance obligation. Even discount voucher and loyalty point is a performance obligation. So if you are selling a goods of 10,000 rupees with discount voucher, there are two obligations. One is good and one is discount voucher. So you have to find out the standalone price, record revenue from purchase obligation other than discount voucher or loyalty point as per Ind AS 115. So if I am selling this good plus the discount voucher, the sale of goods will be accounted as per Ind AS 115 and discount voucher will be treated as a deferred revenue and will create a liability in the books, because we have an obligation to deliver goods or service at a discounted price at a future date. Suppose the customer does not apply for discount voucher, then we will transfer it to revenue when the voucher will expire. Sometimes the loyalty points are serviced by the third party. So I will sell this FR compiler book and I will give you a coupon and I will say you can go and purchase petrol from the nearby petrol pump, show this coupon voucher and they will deliver you the petrol. Okay, so my loyalty point is serviced by petrol pump dealer. Then the amount paid to the third party for compensating the cost incurred is treated as cost of goods sold, because that will also be treated as a cost of goods sold towards this book. So step number 3 is determining the transaction price. So dear friends, I'll just repeat, please don't mind. You will find this book FR Compact, which contains the entire theory. You will see in a very nice manner and you will enjoy this book. So kindly purchase it from our website vinod.in, or you can purchase this summary chart book from our website. The summary chart contains the entire Ind AS, your entire syllabus in a diagrammatic format, easy to revise last minute before the exam. Available on our website vinod.in. Now we'll come to step number 3. Thank you Rishabh for joining, thank you Rahul for joining, thank you Prasad for joining, thank you every other student who has joined for this live session on YouTube. So step number 3 is determining the transaction price. It is the amount of consideration. What is transaction price? The consideration an entity expects to be entitled to in exchange for transferring the promised goods or service. The consideration entity would receive on transfer of promised goods and service, and transaction price can be affected by the nature, timing and amount of consideration. Now it includes, transaction price includes significant financing component also, that I am going to explain afterwards. It is like making payments over a period of time, so it might include some interest also. It may have some variable component also, like incentive, bonus. It may include some amount payable to the customer also, like rebate or refunds to be given, or it may be also including non-cash transaction like goods for goods. So these are the factors which will affect the transaction price. Now I am going to explain significant financing component. Suppose this is year 0, goods are sold here and payment will be made after 3 years, 1 lakh. Will you recognize a revenue of 1 lakh today? Will you recognize revenue of 1 lakh today? The answer is no, because if somebody wants to buy today, he will not pay 1 lakh, he will pay less than 1 lakh. there is a significant financing component involved. It involves interest for 3 years. So significant financing component, if included in the transaction price, we need to adjust the revenue to be recognized. So check, very simplified manner, right, line by line we have written. All of you are requested to understand. Check, consideration is variable. 3 points I will write. Consideration is variable due to reasons beyond the control of the customer. If the consideration is variable for reasons beyond the control of the entity or the customer, for example, sales based royalty. If the revenue is based on the amount of sale, if the royalty is based on amount of sale, it is variable which is beyond control of entity or the customer. Second is delivery of the goods or services at the discretion of the customer, although the advance has been paid. And the third thing we have to check, delayed payment or advance payment are due to reasons other than financing. For example, student says, sir, please send this book to me, I'll pay you after 1 year. I say, sorry, I have a risk of bad debt, you have to pay me in advance. So in some time the supplier insists on making advance payment because he does not want to take bad debt. Sometimes the customer delays the payment. He says, first you construct this bridge, then we will take 60% payment after 3 months. He wants to have quality assurance. If either of these 3 conditions are present, if either of the 3 conditions are present, there is no significant financing component. There is no significant financing component. Okay. But if the answer is no to all the above points, if the answer is no to all the above points, that means the variation is not because of these 3 reasons, then the next thing I need to do is to check the gap between the transfer of goods and service and the transfer of payment. When is goods and service transferred? When is the payment transferred? Now to keep the standard simple, they have said, if the gap is not more than 12 months or financing component is not considered significant, then the contract does not have significant financing component and no adjustment is required. If the gap is less than 12 months, suppose only 3 months credit is given, 6 months credit is given, 9 months credit is given, then you can treat it as no significant financing component. Or if the amount of financing component is also not significant, if you pay now, you pay 100 rupees. If you pay after 1 year, you pay 100.10. So financing component is not significant, then you treat it as no significant financing component and no adjustment to the transfer price is required. Second is, if the gap is more than 12 months, and plus financing component is significant. Financing component is significant. Year 0, year 3. If you pay now, you pay 1 lakh. If you pay after 3 years, you pay 1,35,000. So gap is 3 years and 35,000 is a significant financing component. Then check the rate of interest given in the contract. Check the rate of interest given in the contract. If it is not given, then calculate IRR. So this is important for exam purpose. They have asked question on this. Check the rate of interest in the contract or calculate IRR. If the rate is approximate to market rate in similar financing component, that means in the market, if you borrow money for similar type of situation, then if this rate is equal to this, you can use that rate for adjustment. But if the rate given in the contract is not approximate to the market rate, use incremental borrowing rate on payment to adjust the significant financing component. So this is what you will do for significant financing component. If the answer is yes to any of the above 3 points, but if you find that variation is due to any of the above 3 points, contract does not have significant financing component. So if the contract has significant financing component, what you will do? Either the contract liability will be adjusted with financing cost, or trade receivable will be adjusted with financing income, depending upon whether the customer is delaying the payment or customer is making payment in advance. Accordingly, will create a liability or a receivable. Now another highly tested question in the exam is variable consideration. That is, the consideration is not a fixed amount. It can vary due to factors like discount, rebate, refund, credit, concession, incentive, performance bonuses, etc. Okay. Variable consideration may be estimated either using. So please note down that this variable consideration part is very important. There are two ways to record the variable consideration. One is called expected value method, EVM. Expected value method will be used when there are large number of possibilities. When the number of possibilities are high, use expected value method. Here the formula is expected consideration into probability for each range or estimate should be given. So they may give you sale can be between 1 to 500. The price will be 30 rupees. Probability is 0.3. Sale can be 501 to 1000. Price will be 29. Probability 0.4. Sale can be 1000 and above, something like this. Price 28. Probability 0.3. Then you will multiply. Take the total. This is called expected value method. This is called expected value method. And the second one is called most likely outcome method. So this we will call EVM. This will call MLO. When small set of probabilities exist. A small set of probabilities exist. So then we'll consider most likely outcome as estimated consideration. So the one with the highest probability given, the one with the highest probability given will be taken. The one with the highest probability given will be taken. Now, when you are having variable consideration, we'll have to apply one test called constraining or limiting the estimate of variable consideration. Variable consideration is only recognized if it is highly probable that a subsequent change in the estimate would not result in a significant revenue reversal. Very important. Variable consideration will be recognized only when you are damn sure that you will not have to reverse the revenue. Like for example, in case of construction contract, the question in the exam and in your study material, that if you complete the work on time, you will get 5,000 rupees extra amount. Now this 5,000 is a variable consideration that will be received by the entity only if the work is completed on time and as per the specification, as per the quality. But you will consider that in revenue only when you are sure that a significant reversal will not take place. So next point is accounting for non-cash consideration. So very easy. So one party says, I will give you laptop. The other party says, I will give you scooter. So the question is, this laptop dealer who is selling the laptop and receiving the scooter, how he is going to recognize the revenue? This comes in many other standard also. It will be accounted at fair value. If not reliably determinable, it is measured indirectly by reference to stand-alone selling price of the goods and service. So this is how non-cash consideration will be recorded at fair value. Now we'll come to step number 4. Allocate the transaction price to each performance obligation. This is also important for exam purpose. Questions up to 16 marks have been asked on this area, allocation of transaction price. The issue will arise only if there are more than one performance obligation. If the entity has a single performance obligation, if there is only one obligation, then the question of allocation does not arise. However, if there are multiple performance obligations, then allocation is required. Simple. If I am going to sell you this mobile phone and this pen also, both together, I said you buy mobile phone and this pen for 40,000 rupees, then I will have to allocate the consideration in the ratio of relative standalone prices of goods and service. So you will pay me 40,000, but I will have to allocate it in the ratio of standalone price of the mobile phone and the pen. These standalone prices are considered on the date of inception. How to identify standalone price? Sometimes it can be very easy, but sometimes it can be difficult also. Standalone prices are observable market price of goods and service. That is the price at which these goods and services are sold or transacted in the market on its own, which is my first preference. The first preference will be the observable market price, but if such observable market price is not available, then apply the market assessment approach. Apply MA, M-A-A, MA. Apply MA, market assessment approach, that is consider what a customer will be willing to pay for it. What the customer will be willing to pay for it, it is called market assessment approach, which is highly subjective, of course. If market assessment approach is also not feasible, then the next alternative is cost plus margin approach. So first we will give preference to observable market price. If that is not available, market assessment approach. If that is not available, cost plus margin approach. And if that is also not applicable, then we have another method called residual approach. If A plus B plus C are sold for 150 and A is sold for 100, B is sold for 30, so total 130. So what we can do, we can allocate C 20 rupees. That is called residual approach. But here there is a small condition which can be applied only if standalone price cannot be identified for a single performance obligation. Balance performance obligation have observable standalone price. So if A, B, C together are sold for 150, we should have observable standalone price for A and B, then only we can apply residual method. And the next thing, such residual value should fall within a range of selling of such goods. 20 rupees should be in the range of selling such goods. Suppose C is sold somewhere in the range of 15 to 40 rupees. This 20 comes between 15 and 40, then I can take 20 rupees as residual price for C. Now your question is, if residual approach cannot be applied, Suppose the range is 40 to 50. See, range is 40 to 50. Our balancing figure is 20. It is outside the range. Then residual approach cannot be applied and it is left to apply market assessment or cost plus margin approach. Then in that case you have to apply market assessment or cost plus margin approach. If group of performance obligation can be identified, then standalone price should be based on group prices. These prices will later on be allocated in the ratio of standalone prices of individual goods. So A plus B is sold for 120. A plus B plus C is sold for 150, which means out of 150, A plus B is 120 and C is 30. Then this 120 will be further allocated between A and B in the ratio of their standalone prices. So this is called allocation of transaction price to each performance obligation. Now the last step is recognize revenue as each performance obligation is satisfied. So depending upon what that performance obligation is, the revenue will be recognized. So a car dealer will sell car, 3-year warranty, 5 after sale service. So there are 3 performance obligation. You have to first allocate the transaction price over the 3 performance obligation. You will recognize revenue with respect to car when the control of the car is transferred to the customer. Every year you will recognize warranty expense over 3-year, warranty revenue over 3-year period, and 5 after sale service you have to provide. So as and when after sale services would be provided by you, you are going to recognize the after sales revenue part. This is called recognize revenue as each performance obligation is satisfied. The transaction price allocated to each performance obligation is recognized as and when performance obligation is satisfied. Now there are 2 approaches here. One is called over a period of time and second is called at a point in time. Over time means over a certain time period. Like I am teaching you FR and SFM, and suppose it is a 2-year course. So it will spread over 2 years. That is called overtime. Or for example, a contractor who has to construct a building for the client. So he is going to take 4 years to complete this building. So he accordingly will recognize revenue over time. At a point in time means immediately the revenue will be recognized. You will say, sir, I want to buy this summary chart book. I say, welcome. You pay the price, I deliver the book to you, and I will recognize the revenue. That is called at a point of time. Now, for exam purpose, when will you apply satisfied over time basis for revenue recognition? Satisfied over time will be applied when certain conditions are satisfied. Satisfaction occurs when control of the promised goods and services is transferred to the customer. So first you understand when should revenue be recognized? When control of the promised goods and services is transferred to the customer. When you are in intermediate, the condition was risk and reward. Now the terminology has changed. It is not risk and reward. It is the control of the promised goods and service transferred to the customer. So when is control transferred? When the customer has the ability to direct the use of the asset. When the customer will obtain substantially all the remaining benefit from the asset. So factors to be considered while assessing control. So whether control is transferred or not, entity has the present right to payment for the asset. So control is transferred when the entity has the present right for payment. Entity has physically transferred the asset. Entity's legal title of the asset. These are the factors to be considered, and the risk and reward of ownership. All these factors are considered to check whether control is transferred or not. Acceptance of the asset by the customer. These factors will help us to determine whether control is transferred. Now, revenue is recognized over time when any of the following conditions are satisfied. When any of the following conditions are satisfied, revenue will be recognized over time. And if all the conditions mentioned here are not satisfied, then use point in time basis. Then revenue will be recognized at the point of time. So what are the conditions? The student will have to remember this for answering question in the exam. Sometimes they give a case study on this, whether you will follow satisfaction over time basis or whether you will follow point in time basis. So first is customer simultaneously receives and consumes the benefit. Example, a teacher teaching FR, SFM, and suppose it's a 1 year or 2 year course. The customer, here it's student, receives and consumes the benefit as it is provided. So in that case, we can recognize revenue over time. Suppose our course started on 1st January 2024 and the course will go up to 31st March 2025. So what I'll do, from 1st April 24 to 31st March 24, 3 months revenue I will recognize in this financial year, and from 1/4/24 to 31st March 25, this 12 months revenue we can recognize proportionately in the next year. Suppose in your office your boss does accounting work for a client and he has to do account writing for 12 months. Then as and when the account writing work is getting done, the customer is able to enjoy the benefit. Second condition, this was 1, this is 2, asset which is controlled by the customer is being improved or increased in value. So the customer has given you a land and you have to construct a building over it. So as and when you are doing construction work, the value of this asset is improved or increased in value. So in that case also we can apply satisfied over time basis. Example, A Limited has a plot of land, B Limited is doing construction on it. When B Limited does construction, asset is improved. Or third condition, these are either or condition. Either or, if any of them are satisfied, you will follow satisfied over time basis. There is no alternative use to the entity and the right to seek, and the entity has a right to seek payment. That means whatever you have done, it is of no use to you. But yes, as per the contract, you have the right, you are entitled to seek payment for the work done. The entity has a legally enforceable right to obtain the revenue. Then in that case, you will recognize revenue as and when the work is performed. For example, in your office, you do statutory audit. Once you perform statutory audit, let us say you have done statutory audit 60%, and for some reason the client says no, you can't work further. Whatever you have done is of no use to you. but you are entitled for that 60% of the work done. If this is the case, then revenue will be recognized on satisfied over time basis. When will revenue be recognized at point in time basis? When none of the three criteria mentioned for satisfied over time basis are fulfilled, then we will follow point in time basis. So point in time basis means revenue is recognized when the entity transfers control of the asset to the customer. Now the next task is to understand some special business models. Like for example, consignment. Consignor sends goods to consignee. This type of question they ask for 4 to 8 marks in the exam. When should revenue be recognized? When consignor sends to consignee or consignee sells to a third party? That is the question. So we have to apply this test. If the goods cannot be returned or transferred by the entity to the others and has obtained payment right, then we will call it as a sale. But if the other party can return the goods, can transfer the goods, and will make payment only after he has sold goods to other party, then it is a consignment arrangement and revenue will not be recognized until the consignee sells the goods. Principal and agent should recognize revenue, and how to identify whether the other party is your principal or agent. So, and if the entity has inventory risk, I have sold goods to another party, but then I carry the inventory risk. If he is not able to sell, I will have to take those inventory back. If the inventory become obsolete, that is my risk. If the other party is not able to collect the amount from the customer, I will have to bear the bad debt risk, that is credit risk, and I have to satisfy the performance obligation. Then we are principal. If we are carrying inventory risk, we are carrying credit risk, we are responsible for performing the obligation, then we are the principal. Otherwise, the entity will be treated as agent. So what is the accounting treatment? If the entity is the principal, gross amount will be recognized. Entity is the principal, recognize the gross amount. Suppose you are a person who is a train ticket agent. Your job is just to book a ticket on behalf of customer. Then you are not a principal because you are not responsible for providing the performance obligation. But if you are an agent, suppose the ticket is 2000, your commission is 400 rupees, and if it is an agent, then the revenue recognized will be net amount, means 400 rupees the entity is entitled to retain in return for services as an agent. So this is something important because nowadays there are many websites who are acting as an agent, but in order to improve their top line, they are showing the gross amount as a revenue. So when you will be doing audit of such companies, Make My Trip, Go Ibibo, okay, and Clear Trip, and so many, Yatra, etc., etc., etc. One has to check whether they are acting as a principal or acting as an agent. Some time back, they had asked a question on the model of MMT, Make My Trip. Under that, they provide tickets to the customer, but they are free to decide the price. They take the risk of not being able to sell. They take the credit risk. So in that case, their position will be that of the principal. Now next is repurchase right. A sold goods to B. Then the contract is designed in such a manner that these goods will be repurchased by entity A. The contracts are designed in such a manner that these goods are going to be repurchased by entity A. How to do accounting? So first of all, if there is a repurchase right, but there is no probability of repurchase, there is no probability of repurchase. It's only for theory that there is a repurchase right, but you know that this repurchase is not going to happen. A sells goods to B for 100 rupees, and after 3 months A has a right to repurchase it for 2000 rupees. A has a right to repurchase it for 2000 rupees, which means most probably or 100% probability is that this will not be repurchased. So if there is a probability of repurchase, A sold to B for 150 and A will repurchase from B for 100 rupees, and there is a probability that it will be repurchased. So what the standard says, the difference 50 is nothing but it is a form of lease rental. Amazing. So what B is doing basically, B is paying you 50 rupees for using that asset. A sold to B, B gave 150 rupees. A will give 100 rupees and take the asset back. So B is actually paying 50 rupees for using the asset. Treat it as a lease under IND AS 116. And one more question which they ask in the exam, it is equal or higher than selling price, sold for 100 and will be repurchased for 105. So basically you are paying 5 rupees interest. So this 5 rupee will be treated as this entire arrangement will not be treated as a revenue under this standard, rather it will be treated as a financing arrangement under IND AS 109. You will study in IND AS 109 also that this will be treated as a financing arrangement. Okay. Next is bill and hold arrangement. Bill and hold. So you go to a shop, A goes to a shop and he says, I want this iPhone. iPhone is available. It is on the counter. He takes out, prepares a bill. You accept the bill. But then the customer A tells the shopkeeper that you hold it on my behalf. I will come and collect after 3 days. This is called bill and hold arrangement. Whether the shopkeeper will recognize the revenue now or after 3 days, that is the question. And this is again a theory question for 4 to 5 marks in the exam. So the answer is revenue can be recognized today if certain conditions are fulfilled. Following criteria need to be met in order to treat the contract as bill and sale. First point is the reason for bill and hold arrangement must be substantive, which means customer has requested the arrangement. The request should come from the customer. The customer should tell the shopkeeper that please hold this asset for some time. Sometime A has purchased some interior designing product from the shop, but his office is not yet ready where he can install it. So normally he asks the shopkeeper that this interior decorating item you please keep with you. Once my office is ready, I'll take it from you. So then it is substantive. Customer has requested the payment. Second condition is the product must be identified separately as belonging to the customer. So I gave you an example of an iPhone. So the shopkeeper must identify that particular iPhone and keep it separately. He should put a stamp on that this item is sold to this customer, belonging to a customer. And third is, the product currently must be ready for physical delivery to the customer. If the customer wants, he can take the physical delivery. Customer says, I want iPhone 16. Take this advance 1,50,000. You said that iPhone 16 is not there. So customer says, don't worry, whenever it will come, you deliver it to me. Then in that case, it is not a bill and hold arrangement. Revenue will not be recognized now because the item is not ready for physical delivery. And the next condition is, entity cannot have the ability to use the product. So once the product is sold, entity cannot use it for its own purpose, or entity cannot direct it to another customer also. So the product which has been sold cannot be used by the entity itself, cannot be sold to another customer. If these conditions are satisfied, here all conditions are required to be satisfied. If all conditions are recognized, are satisfied, then the revenue will be recognized. Sales revenue is not recognized when there is simply an intention to acquire or manufacture the goods in time for delivery. So you place an order with a supplier. Supplier says, I am going to manufacture in 3 months and then I will deliver it to you. Revenue is not recognized in such cases. Revenue is not recognized in such cases when the item is not ready, but it will be rather acquired or manufactured in future time period. So the amount that is received from the customer is treated as advance. Holding of goods is treated as a separate performance obligation. If you hold the goods on behalf of customer says you keep this goods with you, I will come after 3 months and collect. Then you will say, see boss, I will hold it on your behalf, but then I am going to charge you some rent for this because I have sold it to you. You should take the delivery. Customer says, okay, I will take delivery after 3 months and you can charge me. That is treated as a separate performance obligation and which is satisfied over time basis. So that will be recognized as satisfied over time basis. So thank you very much. This was a very quick super fast revision of our chapter IND AS 115. So you can revise the entire IND AS by purchasing this book from our website called Summary Chart. And there is one more very good book that is called Financial Reporting Compact. Financial Reporting Compact, which contains the entire syllabus in simple language so that you can revise it one day before the exam. Is it right? Can you see that? And then there is a very good book I have prepared called Compiler. What is compiler? It contains questions from RTP, MTP, exam and study material plus some other good books also. So the student can purchase this compiler. This book is very useful for CA final, CMA final student. Okay. So dear student, thank you very much. Please subscribe to YouTube channel AS Foundation, and we are going to start this series of super fast revision of important IND AS. So next super fast revision is coming soon. It will be announced on our YouTube channel and social media. Please keep watching our YouTube channel and also subscribe, join, ask your friends also, share in all your WhatsApp group, all your friends group, all your Telegram group that this is a very useful YouTube channel and the student will get lot of benefit from this. I have uploaded the lectures on FR, SFM. In fact, all the SFM, RTP, MTP of this year with solution I have uploaded on the YouTube channel. You'll get benefit from that. So thank you very much. See you next time very soon. बंद कर दो ये सारी बुक्स दे दो उधर ऑफिस में